What about what happened with equities this week? It was all over the place.
Well, obviously we were all focused on the Ukraine and what was happening there, but I think it's important to remember that the markets are always being driven by a myriad of factors. Ukraine was front and center, but we also were in a period where we had a lot of buybacks going on. A lot of those tech companies that had sold off a lot probably benefited from that as we got into the end of the week. And of course, we're going into month-end rebalancing. And so that can also cause a lot of trading. So even when things are very whippy, and you don't always say, how does this tie to the headlines with Ukraine? It's important to remember that there's a lot of things going on behind the scenes in addition to that. Obviously, that was the most important thing. And as you said, the possibility that sanctions won't be as hard as they might be, at least for now, might have also helped us get a little bit of a reprieve towards the end of the week.
Kate, I know you're very interested in resources companies. What happened with resources companies?
We actually had a phenomenal week once again for resources companies. You know, in the U.S., the XME, which is the S&P 500 mining ETF, hit a 10-year high today. And globally, we've seen the same kind of thing across resources companies. You know, it has been a phenomenal rally driven by both good supply-demand dynamics as well as some concern over ongoing supply disruptions, particularly from the Russia-Ukraine situation. So you have both the geopolitical and the fundamental side really backing up an incredibly strong rally in a sector, when you think about the miners in particular, that have been so unloved for so long. It was a place I played in many parts of my career. I had to dust off some of my playbooks and some of my skills there.
One thing I'd add to what Kate just said on some of these resource companies is even before Ukraine and the threat to supplies that implies, we already had a situation where demand obviously very, very strong with all the fiscal and monetary stimulus after COVID. But then on top of that, a lot of these sectors had seen underinvestment for years. So supplies were already somewhat low before we had this demand shock. And now we're in a situation where supplies aren't even close to what we need, whether we're talking about oil with underinvestment both in the U.S. and by OPEC countries, whether we're talking about a lot of crops. We've seen underinvestment the last couple of years, partly a weather situation, but supplies very low, and in the metals. And so demand is improving after Omicron starting to fade. Hopefully, the Ukraine situation won't dent that too much. So you have strong demand and these supplies that can't keep up, and this just creates an additional risk on supply. So I think to Kate's point, some of these companies look like a good inflation hedge, and they're also just in a great position to benefit from that increased demand.
Yeah, and I would add on to something else Rebecca's saying, which is in addition to what's happening in the very near term around supply demand, there's also a longer term demand story. A lot of these miners produce metals that are actually incredibly important for the energy transition and for electric vehicles. And we're seeing them undersupplied in the market. We've also seen like some metals like aluminum, for example, or some resources like aluminum, have kind of a bit of a backlash against, how some of the that is produced. And so aluminum producers that use natural gas or cleaner energy to produce are coming into favor. It is a place where I think we'll see continued support for prices over the medium term.
Rebecca, this is a geopolitical crisis with a specific location, which is Europe. And we saw at various times this week a really different reaction in the markets depending on Europe versus the United States. Do you think that will persist?
Unfortunately, I do. We don't know the duration or the degree of the Ukraine crisis, and so obviously that matters. But even if there aren't the worst possible sanctions on energy, they want to get the energy flows to Europe. A third of Russians' oil exports go through the Ukraine. So if you have a situation where they can't get the flows through, you're going to see higher prices no matter what's going on with the sanctions. So what Europe's seen is greater risk of what I'd call a stagflationary shock, where inflation, which is already more than double the ECB, the European Central Bank's target, is going higher. And at the same time, growth is going lower. Part of it is a sentiment shock, but part of it is the inflation eroding people's disposable income. They just have less to spend. So the good news is that going into this shock, growth was improving. So they're starting from a strong place. The question is, how far does this pull them back? And then how does the European Central Bank respond? More to growth or more to the inflation? They're in a really difficult position.
Kate, I wonder about Europe in general, because before this all happened, there were those who were saying this was going to be the year for Europe. Finally, we're going to have the year for Europe because valuations were very attractive. There was going to be better growth. Does this change that dynamic, or did you believe in it to begin with?
Yeah, David, I never believed in it to begin with. And I think those folks that work with me know that, well, let's not call myself a Eurosceptic. but someone who doesn't believe that buying European index exposure makes sense in most scenarios. When you buy Europe, you get a lot of exposure to what I would consider lower quality, lower growth companies. A big exposure to the banks, big exposure to some companies that I would think of as having more stagnant business models and don't have kind of dynamic flow. So it was not something I was really excited about to begin with. And I think one of the things that's not fully priced into European equities right now is the extent to which this Russia-Ukraine conflict could bleed through into European growth. I think it's incredibly important to be selective in your European investments at this point. There are plenty of great high-quality companies that are not just going to be geared towards domestic growth. And I think that's where we need to focus our attention when we think about exposure to the region.
One thing I'd add to your point, Kate, if we're looking for catalysts that could affect our outlook on growth in Europe, would be what happens fiscally. So Europe is getting its act together this year. They're all talking about what should our fiscal framework be, their fiscal policy. Right now, they're set to start imposing their old policies, pre-pandemic policies next year. But they may decide, because of the Russia-Ukraine conflict, to give another extension. So letting governments spend a little bit longer, not putting that austerity straitjacket back on. If they do that, that could be another support to growth that I don't think is discounted in prices right now. We should know that around mid-year. So in addition to what the European Central Bank does, how they respond, this would be another important catalyst that I think could affect views. Again, I agree with you, Kate, certain stocks more than others.